Welcome to Let's Talk Bonds, the bond market podcast from INRBonds. I'm Arjun Patsati. And last week, RBI closed their FCNRB with inflow of scheme with inflows of close to above rupees 50 $50 billion. And the scheme was launched to make sure that the rupee didn't fall too much. It had fallen to record lows in the last 3 months, largely due to volatility in the global markets due to the war in the Middle East between US and Iran and other factors as well. But the question is that is the FCNRB at what cost is this FCNRB and will it protect the rupee? And it was also a free lunch for NRIs and banks. The whole FCNRB scheme is was launched by RBI there in April to bring in dollar inflows so that the Indian rupee did not weaken further. It had touched record lows against the dollar and was threatening to cross the psychological mark of rupees 100 to the dollar. Having said that, once the RBI launched the FCNRB scheme, as well as government took off all the tax on government securities investments by foreign investors and took away the FAR limits on longer dated bonds, the rupee did stabilize a bit. But having said that, um, it's not as if the rupee had strengthened against the dollar considerably. It only stemmed the free fall. Now, what is this FCNRB scheme? Very simply put, um, the RBI said that banks can collect deposits from NRIs, and then they can sell the dollars to the RBI. And if it's a 3-year deposit, the RBI will give them back the dollars, sell the dollars back to them without any cost. As in, there is a forward premium on the dollar rupee on the currency, and the RBI said it will take the cost of the forward premium. Now, if you look at the forward premium, it's for 3-year forwards. It's closing going at close to rupees 5.5, and RBI took the full cost of that of hedging against the fall in the US value of the Indian rupee against the US dollar. So this provided a free, a good return investment, dollar investment option for NRIs. The banks went to the NRI and said, "You deposit, you put $100 in the FCNRB scheme. I'll give you a certain percentage of interest, and in that over that $100, I'll give you another dollar 900, 8 or 500 to dollar 900 as leverage." And basically and they'll give a return X% return on that with taking the cost of leverage. The total return that the investor got, NRS got with the leverage was close to 12%, 10 to 12%, or even higher in some cases. And all this was the cost was borne by the RBI because the banks didn't have to do anything in terms of hedging the forward. So the NRI investor got very good returns on his dollar positions against top class banks, which wouldn't have normally given such kind of returns anyways. And second is that the cost that they didn't have to worry about the cost of depreciation of the rupee against the dollar. The banks then went and sold the dollars to the RBI, and they would have invested in some kind of a rupee asset that is yielding way higher than what they collected from the depositor, and they're making a good spread on that as well. And the RBI here has taken the cost of the cost of hedging the rupee depreciation against the dollar. Now, the total cost to the RBI is estimated at close to rupees 30,000 crores, which is around $3 billion. So that's the total cost the RBI is bearing for this $50 billion of $50 billion inflows through this FCNRB scheme. Now, optically, what it has done is FX reserves in India Indian FX reserves had fallen from highs of $710 billion to $650 billion on outflows. And now with RBI, with this inflows, the FX reserves have gone back to close to US dollars 710 billion. But having said that, is this FX reserves is an optic, is an illusion, because after it's a liability, because at the end of 3 years, the whole $50 billion will go out of the country as the scheme matures for most of the banks. I'm assuming that most of the all the $50 billion were of a 3 year maturity. It could have been lower maturity or even higher maturity. That depends on each bank's scheme. But if you assume that it's 3 years, then at the end of 3 years, the whole thing will go out. And the RBI has, what it has done is, to protect that further losses, it has gone and created forward dollar positions, where it could be from anywhere between 6 months to 3 years. But the most liquid or forward dollar forward dollar market is the 6 months to 1 year period, and they would have created, and they would keep rolling over these positions as the forward contracts mature. At the end of 3 years, what will technically happen is that RBI will sell the dollars back to the banks, and there will be a huge amount of liquidity that is getting sucked out of the system. Now, because of the $50 billion of inflow into the country, the rupee, the system liquidity, which is negative, has gone up to close to $50 billion, is close to an inflow of rupees 5 lakh crores. The system liquidity has gone up to around 3.5 to 4 lakh crores. Um, and so what it effectively does is, and because of these inflows of liquidity as well, the RBI did not raise interest rates in its recent policy, largely because it felt that there was enough liquidity in the system and that they needn't raise rates, despite the fact that global central banks are looking to raise rates. Even the US Fed has considered raising rates. And and the inflation forecasts are are higher than RBI's target estimates. So all put together, it has not touched interest rates because of this liquidity inflow through the FCNRB FCNRB inflows, deposit inflows. Now the question here is, so the scheme one, it was designed to protect the rupee from a free fall against the US dollar. Two, because of the scheme, banks have gained substantially by providing dollar deposits to NRIs and leveraging on them. The NRIs have gained substantially because they got very strong returns on their dollar deposits with leverage, where they wouldn't have got anywhere else in the markets. But the second part is that the cost to the RBI, as we discuss now, is close to dollar 3 billion, or rupees 30,000 crores. Now, so where will this cost be borne? It could be borne from lower dividends to the government, or it could be just taken in as it will be set off against any of their reserves, etc. How the RBI accounts for this cost would have to be seen. Then the third is that the third and the most important question is that, is it really a rupee? Will it really protect the rupee against the US dollar if it depreciates further? Now, the dollar rupee strength is very largely dependent on two or three aspects in India. One is the trade flows, as India imports most of its oil and a lot of gold imports as well, and other imports. And if it's not set off against strong exports and exports of goods and services, then there is a high the trade deficit rises. And because of this ongoing tensions in the Middle East, the oil prices are trending higher again as against what it was 6 months back. And this is lending itself to a weaker current account. The RBI, the first quarter current account was negative, as against a surplus seen in the fourth quarter of FY26. And the first quarter of FY27, we saw a negative current account surplus, but largely offset by capital flows through the FCNRB inflows, as well as FPI inflows through investments in government bonds, and maybe a bit of positive equity inflows, which has been negative for the last many months. But going forward, if there is more tensions, if there is more issues going forward, the fact that global central banks are raising interest rates, and the differential between, say, US dollar deposits and US treasury yields, which are trending higher. The 10-year US is at holding at 4.7%, and the 30-year is at 5.25%, whereas the Indian GSEC is at 6.7% on the 10-year, and 30-year is at 7.4%. It's almost close to, the spreads are close to all-time lows. And all put together, if the spread contracts, there could be a tendency for global investors to shift positions from rupee assets to dollar assets, given that they could be earning reasonably better carry and have more risk protection again by investing in US treasuries than investing in India rupee bonds. Given that if there is further issues of depreciation, then this could weaken the rupee further. So it remains to be seen whether this could be this is a this FCNRB scheme was worth it. But having said that, temporary in the short term, it's lent some stability to the rupee. It's not as if the rupee is strengthened substantially. It has also added liquidity onto the banking system, which could be used for lending and other purposes. But it has also created a 3-year liability, which could impact going forward. And if the rupee continues to depreciate, then the questions will be asked on whether this scheme was actually required, and whether maybe RBI should have resorted to interest rates as a measure to protect to at least stem the weakness, especially to deter speculators from speculating on to make the cost of speculation on the currency depreciation um, as a deterrent to as a deterrent to taking on extremely high speculative positions. Thank you for listening in, and do follow us on all podcast channels.